Welcome back to the deep dive. You've seen it, right? You turn on a financial news channel, and there's a chart with, I don't know, a dozen colorful lines crossing over each other.
Oh, yeah.
And each one is supposedly the secret to what the market's going to do next. It's complete information overload.
It is. It's overwhelming.
So our listener, the learner, came to us with a really clear goal. Cut through all that noise. They sent over a pile of research quant papers, academic studies, even notes from pro traders,
Right.
all to figure out which handful of technical indicators actually have a robust, repeatable statistical edge.
Exactly. And the mission here isn't to find the flashiest new tool. It's to find the most reliable one. We're distilling all those sources down to the absolute essentials.
So what's the common thread?
The research consistently shows that for an indicator to be truly effective, it has to capture one of four things: trend, momentum, volume, or volatility. And, maybe even more importantly, knowing when to use that tool is everything. You have to match your indicator to the market condition. Is it trending? Is it going sideways?
Because if you get that context wrong,
If you get it wrong, even the best indicator on the planet is going to fail. Miserably. And of course, none of it matters without solid risk management.
okay, let's unpack this. The foundation has to be direction, right? Before you can time anything, you need to know which way the river is flowing. We're talking about moving averages.
Moving averages, yeah.
Yeah.
MAs, they are the original and, honestly, still the essential trend filter. They're just simple mathematical tools that smooth out all the day-to-day. Oh, absolutely. That work showed that even very simple rules, price crossing over an MA, had a definite measurable advantage over just holding cash or trading randomly, especially in big market cycles.
Okay, so if we had to pick one,
Hmm.
one single moving average that institutions, hedge funds, algorithms, the one they all pay attention to, which one is it?
It's undoubtedly the 200-day simple moving average, the SMA 200.
And why that one specifically? Why not the 50 or the 20?
Because historically, it acts as this huge psychological and operational dividing line. When a major index is trading below its 200-day, most big money managers basically see it as a bear market.
Or at least a time to be extremely cautious.
Exactly. So its practical use is just undeniable. If you use it as a simple filter, meaning you only consider buying new positions if the price is above it, it's a proven way to help you avoid the absolute worst, most catastrophic market drops.
Exactly.
But step one in Mark Minervini's famous trend template, you're just making sure you're swimming at the current.
That sounds great, but there's an Achilles heel here, right? They are, by definition, slow. They're always late to the party.
That lag is their biggest weakness, for sure. MAs are incredible at capturing those huge, sustained trends. That's why historical tests often show a great reward-to-loss ratio, sometimes as high as 5-to-1.
But the win rate?
The win rate is low, often around 30%. And they fail spectacularly in one specific environment, when the market is just going sideways, consolidating in a range.
Which leads to the whipsaw. Can you just quickly explain what that is for the learner?
Of course, a whipsaw is a false signal. The price crosses the moving average, you jump in thinking a trend is starting.
And then it immediately reverses.
Instantly reverses, crosses back the other way, and stops you out for a loss. When a market is ranging, MAs will just whipsaw you again and again. It's a quick way to lose capital.
Which is why we need tools that actually work well when the MAs are failing. And that sets us up perfectly for our next category, momentum. If MAs give us direction, these tools are about timing and seeing when a move is overstretched. Let's look at the two giants, RSI and MESCD.
What's so fascinating here is that, well, while they both measure momentum, you have to use them in very different ways depending on the context. Let's start with RSI, the Relative Strength Index.
Okay.
So RSI measures the speed and change of price moves. It's on a scale from 0 to 100. Most people know it for identifying overbought, so above 70, or oversold, below 30.
Right.
And that is its real strength, but only in a ranging market.
So if the market's stuck in a sideways box, the RSI acts like an elastic band.
Perfect analogy. When the price hits one of those limits, say it drops below 30, the band is stretched too far, it's likely to snap back towards the middle. That's your classic mean reversion trade.
And that's where you see those really high win rates and back tests.
Exactly. But the sources point out a really critical detail here in how the pros use it, and that's the time setting. The classic RSI uses 14 periods.
Right, RSI 40.
But quants like Larry Connors found that for short-term entries, the hypersensitive RSI 2, using just 2 periods, was statistically superior
2 periods? That must be incredibly jumpy. Why would that be better?
because it's not for predicting a top or bottom. It's for aggressive, short-term timing inside an already strong trend. So let's say a stock is in a clear uptrend above its 200 SMA,
Okay.
and the RSI-2 suddenly collapses below 10. That signals an extreme but very temporary exhaustion. It's a sharp pullback that's likely to reverse very quickly. It lets you catch a high probability bounce.
That's a huge aha moment right there. But this comes with that critical warning, use RSI wrong, and well, you said it's disastrous.
It is. The single biggest mistake traders make is trying to sell or short a stock in a powerful uptrend just because the RSI is overbought.
Because it's above 70.
Yes. In a real bull market, that RSI can stay pegged at 80 or 90 for weeks while the stock keeps climbing. If you try to short that, the market will just run you over. You have to respect the main trend first.
So the sequence is everything. Filter with the MA first, then time with RSI. Okay, so where does MACD, the moving average convergence divergence, fit into this puzzle?
MACD is a really elegant blend of trend and momentum because it's built from two moving averages. But, and this is important, most new traders focus on the wrong signal. They wait for the MACD line to cross the signal line.
And that's a mistake.
It's often very late, and it generates a ton of false alarms in choppy markets. Its real statistical power isn't the crossover. It's as a confirmation tool, specifically for spotting divergences.
Divergences. So that's when the price and the indicator are telling you two different things.
Precisely. Think of momentum as the engine driving the price. A divergence tells you the engine is running out of gas.
Give us an example.
A classic bearish divergence is when the price of the asset pushes to a brand new high. But the MACD indicator fails to make a new high alongside it. It makes a lower high.
So the thrust is gone.
The thrust is gone. The sources all identify this as a high probability warning that the trend is exhausted. It's a great signal to maybe tighten your stops or think about an exit. It tells you the big money isn't pushing anymore.
Okay, this is where it gets really interesting. We have direction from MAs, we have timing from RSI or MACD, but we need confirmation. We need to know there's commitment behind a move.
And you need a plan for risk.
Exactly. Which brings us to volume and volatility. Let's start with volume. If momentum is the engine, volume is the fuel.
And when you talk about volume, you have to talk about the institutional benchmark, which is VWAP, volume-weighted average price. This is way more than just a simple average.
So.
VWAP calculates the average price of an asset, but it's weighted by how much volume was traded at each specific price level.
And that's why big funds call it the just price.
Yes, because institutional traders who are moving huge blocks of shares are often judged on whether they got a good price relative to VWAP. If they buy above it, they paid a premium. If they buy below, they got a deal.
So it becomes a self-fulfilling prophecy.
It becomes a dynamic anchor for the market. It's where the most business is getting done. For our listener, the practical use is this. If the price is holding above VWAP for the day, buyers are in control. It's a bullish intraday bias.
And how do we apply it?
As dynamic support and resistance. But its most powerful use is as a confirmation tool. The sources are unanimous on this. Never, ever trust a breakout from a pattern unless it's confirmed by a big increase in volume.
You check that with something like RVOL, relative volume.
Right. If you see a price spike but volume is drying up, it's almost certainly a trap.
Okay, commitment confirmed. Now for what might be the most important piece of the entire system, risk control, using volatility.
We need to measure volatility for two main reasons. First, to manage a risk. Second, to spot opportunities. For risk, the undisputed king is ATR, the average true range.
What does that tell you?
ATR simply calculates the average price range of the asset over a certain period. It tells you objectively how much wiggle room that asset needs to move normally without, violating your trade idea.
So instead of a random 5% stop loss.
Exactly. Instead of an emotional stop, you set a technical one. The standard rule, validated in the research for swing trades, is to set your stop at 1.5 to 3 times the ATR below your entry price.
It's based on the market's actual behavior, not your feeling.
That's the key. Your risk becomes objective.
Okay, that's managing risk. What about spotting opportunity with volatility?
That's where you look at tools like Bollinger Bands or Keltner channels. You're looking for a volatility squeeze, a period where the bands get really, really narrow.
A compression.
A compression.
Yeah.
Because low volatility almost always comes before a high probability, explosive directional move. It's the quiet before the storm.
Which brings us to the volatility contraction pattern, or VCP.
Yes, the VCP, which Minervini popularized, is basically the visual of that squeeze. You see volatility contracting, and just as important, you see volume drying up during that contraction. It suggests smart money is quietly accumulating shares, and the stock is coiled up, ready to explode higher.
Okay, so we've got all these incredible tools: MAs, RSI, MACD, VWAP, ATR. But the sources are clear. Using them by themselves is not the answer.
No, success comes from combining them, from making sure they confirm each other across different dimensions.
Yeah.
This is the whole idea of confluence.
The triple screen model.
Right. It's useless to pile on 4 different momentum indicators. You need one from each category: trend, timing, and confirmation.
So let's walk the learner through a practical example from the sources. An ideal swing trade setup. Step 1. The regime filter.
Filter first, always. You only operate on the long side if the price is clearly above the 200-day SMA. That's non-negotiable. You're in a bullish regime.
Step 2. Timing the entry. The trend is up, so we don't want to chase the highs. We need to wait for a dip.
You wait for that temporary weakness, a pullback. This is where you use your momentum tool. You wait for the RSI 14 to drop back to a neutral zone, say between 40 and 50. You're letting the short-term panic pass.
But you haven't bought yet.
Not yet. Now you need step 3. The entry trigger and the risk placement. The entry could be the price breaking above the previous day's high, but it must be confirmed by a big spike in relative volume in RVL.
Showing commitment.
Showing commitment. And maybe intraday you see it reclaim the VWAP. The second you enter, your stop loss is immediately placed, say, 1.5 times the ATR below your entry.
Trend, timing, volume, and risk. All aligned.
That confluence is what gives you a statistical edge. You're minimizing the chance of getting whipsawed because you waited for confirmation.
That structure just makes the whole process so much cleaner, less emotional. Okay, let's wrap up with the critical warnings, because there is no magic bullet here.
No. Warning number 1, and we can't stress this enough, is the lag. Every single one of these price-based indicators is telling you what already happened.
They're reactive, not predictive.
Exactly. Use them for context and confirmation, not for trying to guess the future.
Warning number 2 goes back to what you said in the start. Context is king.
It is. If you use moving averages in a sideways market, you will get chopped to pieces. If you try to short every RSI overbought signal in a raging bull market, you will get destroyed. The 200 SMA is your first best guide to context.
And the final warning about those beautiful backtests.
Ah, yes. The trap of overfitting. A system can be tuned so perfectly to past data that it looks incredible, like a 90% win rate.
But it only works on that specific data.
Correct. If your strategy doesn't work on data it has never seen before, what we call out-of-sample testing, then it's probably a mirage. Simple, robust rules always beat complex, over-optimized ones. Discipline is 80% of this game.
So for the learner listening now, the immediate takeaway, the roadmap, is pretty clear.
It is.
Start with a clean chart. Put on the 200 SMA, the 50 SMA, and volume. That's it. Then just focus on that simple 3-part rule we outlined.
Trend filter, timing the pullback, and an ATR stop for risk.
Master that confluence before you even think about adding anything else.
And remember, this knowledge gives you a statistical edge. An increased probability, it never gives you certainty. The real skill is sticking to the system, especially when it's giving you a few losses.
That is the essential insight. Thank you for walking us through this. It's been incredibly clarifying.
Of course. But before we wrap up, here's a final thought for you to explore on your own. We know that the market's behavior is it's non-stationary. It changes over time.
Right.
So given that the biggest algorithms and institutions now rely so heavily on these exact same benchmarks, especially VWAP and the 200 SMA, how might that change things? How might that increasing reliance shift the effectiveness of these traditional strategies over, say, the next 5 years?
A fascinating problem. Are the tools becoming so popular that they become less effective, or do they become even more powerful, self-fulfilling prophecies?
Something to think about.
Definitely something for you to mull over as you start practicing these techniques on a demo account. Knowledge is power, but practice is what makes it profitable. That was the deep dive. We'll see you next time.